Hey there, option traders. Welcome back to the channel. Today, I'm going to share a put credit spread strategy that's probably very different or a little bit different than what you are used to trading. The difference in this strategy is that we're going to be looking at trading at the money put credit spreads, selling put credit spreads, as opposed to out of the money spreads, which you're probably familiar with that have a higher probability. And there's a couple of reasons to consider selling at the money spreads versus out of the money spreads. First reason is that in this current environment, the VIX is very, very low. We're sitting below 13 as I'm recording this. So when you're selling an out of the money credit spread, you're not going to get very much premium for the spread, which also means that the spread you are selling is going to be closer to the money anyways. So the second reason to consider an at the money put credit spread is because the premium is going to be higher, which means your max gain is greater and your max loss will be less per trade. So the risk reward is not going to be as skewed as maybe you're probably used to. Now, I know what you're probably thinking. Doesn't selling at the money spreads mean that you have less of a probability of winning? And the short answer to the question is yes, but if you're using no analysis outside of the options market themselves, outside the probabilities that you see in the options chain, then yes, you're not going to have an edge. And as you probably know, there is no edge over the long term if you're just using those option probabilities by themselves. Now, if you're someone who believes in stops that will protect you from those larger losses that you normally might see with out of the money put credit spreads or out of money credit spreads in general, you probably had the experience of getting stopped out and then only for the market to kind of go back in your favor and for your options to eventually expire worthless. But you weren't able to stay in that trade because you had a stop. And that's one of the things we all have to deal with when we're trading these type of trades, is the fact that when you're trading out of the money spreads, controlling the risk in case the trade doesn't work out is very, very important, because the risk reward can be very, very skewed, which gets us back into to consider selling at the money spreads. Now, let's go ahead and get into this sort of different way of looking at selling these spreads. Since the at the money spreads have about a 50% chance of success, we need something else that's going to lean the odds in our favor to improve our win rate and definitely define our edge. So in order to get an edge and improve both our win rate and profitability, we're going to use two simple analysis tools to know when you should trade these at the money spreads that are going to allow us to transform an at the money put credit spread strategy into a high probability strategy. Now, for this video, we're going to be focusing on spreads that expire the following day using SPX weekly options. You know, there's 5 expirations per week. So we're going to be researching selling 1 day to expiration spreads at the end of the day that expire the following day. And if it was on Friday, it would be a 3-day spread. So we're looking at selling those spreads that expire the next trading day. Now, before we get into the high probability part, let's just look at the options backtest for selling an at the money spread every day. I'm doing this for the entire year of 2023, all the way up through December. That's when I'm recording this, first, second week of December. And we can see that if we sell an out of the money spread 5 wide that expires the following day, that we ended up with a 59% win rate. So this is a little bit better than 50%. And I think probably because we're in a little bit of a bull market mode this year. I wouldn't say a full bull market, but we've had some more bullish periods. So the odds are probably leaned in the favor there for that put credit spread to do okay. But I do want to identify the risk reward here. So when you're selling that at the money spread, where the short strike is right at the money or 1 strike outside the money, you're typically going to get around $200 of credit per spread. This is a 5 wide. And what that does is make the max loss only $300, where if you go farther out of the money, you may only get $1, and now you're risking 4 to make 1. In this particular setup, you're risking 3 to make 2. Now, for the sake of this study, there's no stops, there's no profit targets. We're simply just gonna let the math play out, the options probability math, and see what we end up with. And this is what we ended up with. Let's call it a 60% win rate. Our winners were about 199 and our losers about 284. So it's a little bit better than a 3-2. And we made about $941. But when you look at this, it's pretty random and all over the place. So there's really no edge here. Like I mentioned before, there's no edge in just going with the option probabilities by themselves. So instead of selling them every day of the year, where there's 1 DTE, What if we said, okay, we only want to sell those if the market's above the 10-day moving average? So what does that mean? That means on the daily chart at the end of the day, if the market's above the 10-day moving average, the market's in some kind of bullish mode. It's at least higher than the average of the last couple weeks. And this improved the win rate a little bit, which also improved the profitability. We went from 60% to almost 63%. So let's call it a 2-point-something% increase. But it really helped the profitability, making over $2,500. But the risk reward is still about the same. And that's what's key when we're trying to compare these strategies, is really making sure that the risk reward is the same so that we can find the analysis we need to find that edge. So in this case, still about $280 for the average loser, and the average winner was about $196. One thing I'll mention too is that before we had 233 trades when we traded every day of the year. And when we traded with just the market trading above the 10 SMA, we ended up with 147 trades. So we're trading less, right? We're only trading when the market's in a bullish position, and we're making more money because of that. So that's the edge. We're finding the edge outside of the options market. Now, before we get into the results of the next study, I want to talk through this particular tool or indicator that will help improve this already. So again, we went to 147 trades and making more money. But over on Alpha Crunching, there is a new indicator that we put in there called the TTR, which tells you the historical rate at which the SPX has closed higher the following day. So we call it the TTR tomorrow's triumph rate. It's posted every week before the market opens it's usually updated by Friday night or Saturday for the following week. So before the trading week begins, in this particular week, we can see that Monday, the TTR is 67%, which means that Tuesday has closed higher 67% of the time. So we know that this may be an additional edge that we can trade that 1 day to expiration put credit spread. And then on this day, it was 63%. So anything that's 60% or higher, I've identified as a bullish mode, and we combine that with the 10 SMA, we actually improved the edge. You can go back and look at previous weeks. You can see these numbers change a little bit. So on this particular week, if the market was still trading above the 10 SMA and we added this edge, we would end up with 4 trades this week, a 1 DTE on Monday and Tuesday. Wednesday was actually bearish, which we can talk about in another video. And then we have 1 DTE on Thursday, and Friday would be a 3 DTE put credit spread that you could trade, again, right at the money. If we go back into the backtester, and now what we're doing is we're only trading that put credit spread if it's above the 10-day SMA and that TTR value is bullish. And we dropped our number of trades to 57 trades, which, isn't a lot of trades for an entire year for a strategy. However, look what it did to the profitability. You're trading way less, your win rate is much higher, but the win and losses are still the same. Our risk reward is still the same, so we're able to compare these strategies. So if you want to trade less, then you'll use both of those indicators to help boost your win rate and your profitability. So we still have an average loser of 290, just under 300, an average winner just under 200. And one metric we didn't really mention, but this average per trade skyrocketed to $76. In the original, just trade it every day, let the math play out kind of situation, the average per trade was $4. When we did it just using the moving average, the average per trade was $17. But when we add both the moving average and the alpha crunching TTR, we ended up with an average trade of $76. Again, there's periods of time where those edges, all those things stacked together aren't going to be in place, and you simply just don't trade. And this is the power of not trading. Retailer traders like us, we don't have to trade. So if you have something that can keep you out of the market and improve your profitability, I think you're going to be better off. So if you're interested in learning more, head over to alphacrunching.com and check out the tools there for trading SPX and ES futures, and I'll see you in the next video.